Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for Wednesday the 13th of March. Thank you for joining me this morning. In just a moment, I'll have an update for you on the top business and finance stories this morning from around Asia. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's headlines, the annual inflation rate in the US unexpectedly edged up to 3.2% in February, compared to 3.1% in January, and above forecasts of 3.1%. The monthly rate also rose to 0.4% from 0.3% as expected, with prices for shelter and gasoline contributing over 60% of the monthly increase. Core inflation, that eased to 3.8%, and while that was the smallest increase since 2021, it was also above economists' forecasts. Japan's producer price inflation index rose 0.6% year-on-year in February, beating the 0.5% expected by economists and quicker than December's figure of 0.2%. That was the highest producer inflation since last October. And in India, inflation came in ahead of expectations as well, at 5.09% in February, driven by soaring food prices as the country prepares for a national election in the coming weeks. Food prices, which account for half of the overall consumer price inflation basket, rose by 8.7%. A US trade and investment mission to the Philippines has pledged $1 billion of fresh investment in the country from companies including Microsoft and United Airlines that were part of a 22-strong business delegation visiting the country. US Commerce Secretary Gina Raimondo has called for a sharp increase in capacity for assembling, testing and packaging semiconductors in the Philippines as Washington seeks to bolster rapidly growing defense cooperation with its oldest Asian ally. Ms. Raimondo said the United States is constantly assessing the need to expand export controls to stop China from acquiring advanced computer chips and manufacturing equipment that could be used to boost its military. On today's programme, I'm joined by Enzio von Pfeil, Capital Preservation Specialist at Financial Shield, and James Wong, Chief Executive Officer at Cathaysia Securities. With a view from Japan is Dan Kerrigan, CEO of Interactive Brokers Securities in Japan. And there are several ways in which you can get in touch with the show. You can go to peterlewismoneytalk.substack.com. On Facebook, the page is Peter Lewis Money Talk, or you can tweet the programme at Money Talk R3.
Peter Lewis's Money Talk.
US stocks closed sharply higher following Tuesday's inflation numbers. The S&P 500 ticked up 1.1% to finish the session at 5,175, surpassing the previous record high close from March the 7th. The Dow gained 236 points, or 0.6%, to close at 39,005. The Nasdaq Composite advanced 1.5% to 16,266. 6 out of the 7 Magnificent 7 stocks advanced. Nvidia soared 7.2%, Meta rose 3.3%, and Microsoft went up by 2.7%. Government bonds fell following the US inflation data. 2-year Treasury yields rose 6 basis points to 4.59%. After the CPI data, a May rate cut was taken off the table with odds of just 11%. The chances of a 25 basis point rate cut in June stand at 70%, according to the CME's FedWatch tool, and 83 basis points of rate cuts are priced in throughout the year versus 88 basis points pre-CPI. The US dollar index was 0.1% higher. The Japanese yen was sold following remarks from BOJ Governor Ueda noting some weak economic data recently, and Bloomberg sources suggested a March interest rate hike is now too close to call. The yen ended the day 0.5% lower at 147.66 versus the dollar. In Shanghai, the yuan was flat at 7.18 renminbi per dollar. Gold erased Monday's gains following the hotter than expected US inflation number. Spot gold slipped 1.2% to $2,156 an ounce. The Brent crude oil contract for May fell 0.4% to $81.92 a barrel. Bitcoin reached an all-time high of 72,968 on Tuesday, before paring gains to just above $71,000. In Hong Kong, shares of Chinese companies listed in the city surged on Tuesday, with consumer stocks, property developers and tech companies rising sharply. The Hang Seng Index surged 506 points. That's 3.1% to a 3.5-month high of 17,094, and it raised all of its losses now for the year. The tech index rose 4.6%, rebounding 20% from its January low and putting it in a bull market. The Hang Seng China Enterprises Index of mainland companies listed in the city jumped 3.5%. On the mainland, the CSI 300 index rose 0.2% to 3,597, and the index has rebounded 13% after hitting a 5-year low in February. And stocks here in Hong Kong projected to open about 65 points lower, futures markets pointing to the Hang Seng starting the day at about 17,030. You can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
And to welcome our Wednesday morning guests, we have with us Enzio von Pfeil, Capital Preservation Specialist at Financial Shield. Good morning to you, Enzio.
Morning to you, Peter.
And also with us, James Wong, who's Chief Executive Officer at Cathaysia Securities. Good morning, James.
Good morning, Peter.
The annual inflation rate in the US unexpectedly edged up to 3.2% in February. That's compared to 3.1% in January, and it was above forecasts of 3.1%. The monthly rate also rose to 0.4% from 0.3% as expected, with prices for shelter and gasoline contributing over 60% of the monthly increase. Meanwhile, core inflation eased to 3.8% from 3.9%, while that was the smallest increase since 2021. It was above economists' forecast of 3.7%, and on a monthly basis, US core consumer prices, which exclude volatile items such as food and energy, rose by 0.4% from the previous month in February. That's the same as January, and above again market expectations of 0.3%. Enzio, I'm trying to work out, is this good news or not for the Fed? The second straight 0.4% reading for core CPI. I think, analysts in the market are sort of taking this that January wasn't a one-off sort of anomaly, and therefore maybe inflation is rather sticky, and that isn't good news for the Fed. But what do you think?
Well, I think we need to change the view of what we're looking at. It seems to me that the Fed focuses actually on a very different inflation indicator called the Personal Consumption Expenditure Price Index, the PCE. And it comes out monthly by the Bureau of Economic Analysis, was released latest on the 29th of February, stood at an annual 2.4%. That's only 20% above the targeted inflation rate of 2% that the Fed has. So when the Fed is saying it's targeting 2%, it's not of the inflation rate that the normal consumer uses. It's this PCE inflation rate, and that actually has improved a great deal. It was in October about 30% above the target. It was at much higher, and now it's down to 20% above target. So I think actually it's on the right track. So I'm less. Yeah. How
different is this PCE measure of inflation from the inflation measure from the Bureau of Labor Statistics that we had last night from the US? How different are these two measures?
It's a very good question. I think the key is that it focuses solely on the US consumer. It does not have all this stuff with these, as far as I know, with all of these raw commodity prices in it. It's a much more narrowly defined basket focusing solely on the US consumer. And I think that's the big difference to the much broader labor market index, which you always have with the core price inflation as opposed to the overall inflation rate.
And is one of them more reliable than the other?
Yes, I think that this per capita expenditure index, the one that I was blathering on about, that's, reliable. That's the one that the Fed really seems to use more. So that, I think, is where the attention should be focused. Like I said, it comes out at the end of every month by the Bureau of Labor, by the Bureau of Economic Analysis.
Okay, James, what are your thoughts on this? Is inflation sticky? Is it moving sideways? What direction is it going in?
Yeah, it's a little firmer than we expected, and it makes what Larry Summers said about a possible rate hike a little more realistic. But even though I think it's still more of a plot of a ghost story. It was too scary to have another rate hike, but now we can see, just like you said, it's not a seasonality that drives the January inflation high. It's now 2 months in a row. But then the market is not responsive, at least the equity market is not responsive a lot to this CPI print, not as much as it has in January for the last CPI print, because last time the market was expecting about 1.2% of a movement in terms of equity market performance in relation to prior to the CPI print. But this time we're only pricing in about 0.7% of a movement. And so that's why I can see it was not ideal. But then when it was out, bonds took a hit, but equity markets were still very much excited, and the S&P printed a new all-time high close. So I think people are were kind of anxious about the CPI print, but now when it's out, they saw it was not that bad, and they were a little more calmed, and the bond market reacted a little much, because I think the 10-year auction was not ideal, was not as pretty as the 3-year auction yesterday. And but the small caps, the equal weighted S&P index was not as pretty today as the cap weighted in the S&P and as the large cap dominated NASDAQ. So I think the high rates, the high break-evens, the possible delay in rate cuts are having effects on small caps or on medium caps. But for mega caps, which have been protected by the enthusiasm in sentiment and by momentum, these are basically still untouchable.
So let me ask you, you mentioned Larry Summers, and he said last month that, there was a chance that rates could go up, although he said not a big one, but nevertheless, he thought it was a bigger chance than maybe people were pricing in. We've now got, in effect, a couple of more months before June when the markets are anticipating rates to be cut. So we're going to get at least 2 more months of inflation data between now and then. What are the chances that actually, not so much that rates go up, but the Fed just doesn't feel able to cut rates? And what we find is that, we end up stuck where we are for the rest of the year at the current level of interest rates.
I think it's still slim. A couple of Fed officials, the governors, have stepped out and said something about what you just said. And I think Master Kashkali, they were all pretty consistent on saying the economy is in a good place, the big picture is in a good place, and they talked to enterprises owners, and those owners told them that the economy and their expectation on the economy is on the rise. So in a scenario like this, they are questioning the Fed's decision to cut rate that fast. So some of them said it's going to be in the later half of the first rate cut is going to be the later half of the year. And it's not going to be a consecutive decision. It's probably going to be the first one, first rate cut. Then the Fed is going to take a pause and then observe continuous data points, and then take another rate cut, and that's about it for the year. But I still think it's probably going to be 3 times this year. And we are waiting for the FOMC statement and Jay Powell's press conference this month. I think a better outcome, or a more dovish outcome for the FOMC statement, is the dot plot being the same, or the median of dot plots being the same as last time. which means they're still going to show three rate cuts this year.
Enzio, where are we in terms of interest rates right now in the US? Jerome Powell describes them as being restrictive, but are they really restrictive? When you look at financial conditions in the US, we've got stocks at all-time highs, for example. That isn't so restrictive, is it? That's quite loose.
Good point. Yeah, and that's also very much in line with my economic clock, which focuses on the excess supply of money, the liquidity swishing around the system, not on the price of money. And it was also a learning experience for me, quite frankly, to understand that just because the Fed was raising rates a couple of years ago did not mean that it was tightening, because it was still very loose financially with its liquidity, and with the economy also not exactly bubbling along at super duper speeds. There's an awful lot of excess money around, and that logically continues finding its home. And I'm not seeing, whilst the Fed has been reducing this excess money, this excess supply of liquidity, it has not really tightened liquidity. It has just been it, and now it's talking about reducing the price of money. So I'm in with you, Peter, that the financial conditions, as every central bank in the States comes out with, they are still quite loose, and that will continue. So there is really not that much tightening going on.
And where is this excess supply of money coming from?
Well, I think it's probably less consumer demand. I think that the overall corporate investment and consumer demand is such that the savings rates are depleted, but they are still there. But people are more income insecure. And that means that they don't want to shop as much as they used to. Because of that, the corporations don't want to invest as much as they used to. And so that's where you're finding this liquidity coming from. It's just this, it's people not really wanting to spend and corporations not wanting to invest as much.
And is some of it coming from the government? We know that the government, James was mentioning it earlier, is issuing a lot of bonds, more than the Fed is rolling off its balance sheets, and the Fed buys those bonds. So presumably there is an excess liquidity coming there as well, which has to go somewhere.
Very good point. Yeah. Excellent point. Yeah. That's the other big one, that the Fed is buying the bonds, and that then of course it gets paper and it gets bonds and it gives money into the system. So that is also a key point. But I think the big one in my mind, maybe more intuitively, is more what's happening in the private sector, that the private sector just doesn't need as much cash at present.
And this liquidity is going into the markets, isn't it? I presume this is one of the reasons why we're seeing all-time highs in so many things, in US stocks, in European and Asian stocks, in Bitcoin, in gold. This liquidity is driving all these different asset classes. Yeah,
and that's how the clock works, that when you have too much money swishing around, which is what we call the excess supply of money, also dubbed liquidity, then it has to go into asset markets. That can be houses, that can be stocks, bonds, that can be car collections for all I care. It's just that the retail market is so deep in the US that, of course, that's a very major source of where this money can find a home.
So, James, if we have this excess supply of money, liquidity, as Enzio has just explained, and we have that money needing a home and going into the markets, presumably with financial conditions actually not that tight, sort of quite loose, presumably you shouldn't fight that. You should just carry on buying US stocks or your Bitcoin or gold bars or whatever.
Yeah, of course. The number of asset classes that we're looking at actually all experienced a lot of liquidity pumping into them. And funny that Enzio mentioned about gaming cards. We were a couple of asset managers, and I was just talking about gaming cards being hiked up in price. One of them, I think it's a one-piece gaming card, is just sold for 3 million Hong Kong dollars. It's just one card.
Really?
And wow. 3 million. Yeah, but it's gotta be rated in the US by a professional agency. It's gotta have a perfect score, but that's another story. But if you remember, about 5 months ago, I think the singer Post Malone bought another Lord of the Rings card for about $1 million USD. but that card only rated for 9.5, so he actually made a loss. But that's been that. The rest of the investment community, I think, is very excited about what things are going right now, because the things that we were worried about, including the end of BTFP, the quick draining of the overnight reverse repo facility, all of these have not impacted liquidity at this point, because at one point we've seen the overnight reverse repo facility being a pool of funds and being a benchmark of liquidity, and it's being drained very quickly from the highest level of 2.4 trillion to about below 700 billion right now. And but then we've seen the bank balance sheet in the United States have been expanded about the same size. So I think the liquidity is still here, it's still flowing around, and because the city's economic surprise index has been falling since mid of February, I think the market is not expecting Fed to tighten or to continue its course of quantitative tightening like it has been in the past year. So that's good news.
So let me ask you, is all this liquidity that's frothing around, are you worried that a bubble's forming now?
I think the bubble has been formed a long time ago. So we are in the bubble. There's no doubt. The point is, how far can it go? But what I think is, if you can ride a momentum, then you ride the momentum. It's not really smart to ride against the momentum and to bet against a wave that is going up.
So Enzio, tell me then about Japan. What is your economic clock saying about Japan and about the liquidity situation there?
Well, it's not different to the US, really. You have the prospect of higher rates coming through. So the economic time, but again, would be excess supply of money, excess supply of goods, moving though, and this is the interesting thing with Japan, a change in economic time from the excess supply of goods to an excess demand for goods, which goes to say that with wage hikes coming in, as you reported, of 6.7%, that's a huge number for Japan. I mean, in our days doing Japan, 3 to 4% was already pretty gargantuan. So the rising wage rates would suggest that there will be more consumer confidence coming through. That in turn will feed corporate domestic investment, and that in turn will feed corporate profits, and thus that will help the stock markets. But on the monetary side, even though the Bank of Japan is saying, and I tend to agree, if I may, in my humble way with that there will be a rate hike going from negative to positive, there'll still be this excess supply of money, this liquidity sloshing about for a long time, as it has indeed for years. So the big changes on the real economy.
So even if the Bank of Japan raises rates, they're at minus 0.1% at the moment. They're still going to be very low, aren't they? So presumably this isn't going to change the situation of there's still a lot of liquidity around in Japan as well.
Absolutely. And that's been the big lie of the central banks really for the past few years, that are not the lie, but I mean, we in the market, I was part of that. I thought that by raising rates, they were tightening. It took me a while to understand that just because you're raising the price does not mean that you're reducing the amount of excess money around. So that's where the liquidity comes in. So price of money is different to the quantity of excess money around.
And how far do you think the Bank of Japan can go in raising rates? Are they going to take them from minus 0.1% to zero and then stick there for a while and be happy? Are we going to see them move into positive territory? Are we going to see them move strongly into positive territory? How far do you think the BOJ can go?
My years of covering Japan always taught me ITT, not the corporation, but it takes time. The Japanese are a very, very cautious people, so I'm not seeing any fireworks on the rates front. I think it's kind of like a 0.1% positive incremental kind of stuff coming through. I don't see any sort of big changes in the rates, or indeed in the yen. I know that it's strengthened a little bit because the US rates surprisingly are going down and the Japanese are going up. But again, I think that's much more traders taking at the margin, if I may say.
So in that case, if we've got this combination of the Bank of Japan still running an easy monetary policy, you've got wages going up sharply, you've got inflation picking up now. Japan isn't even in a recession as the data initially thought. Presumably, this is another market where you shouldn't fight the liquidity. You should go with it. And this market could also go back to all-time highs.
I think so. I think it's not on as firm a footing as the U.S. economy. It's just not as robust, and we saw that with the revisions in the data points. These aren't exactly sort of stellar figures coming out with a GDP upward revision, but at least it's a step in the right direction.
So, James, what are your thoughts about Japan? First of all, the Bank of Japan, how are they going to respond to this latest data showing Japan not in recession as initially thought, wage growth picking up quite sharply, inflation picking up as well? What are they going to do?
Yeah, I think they're not gonna act in March. That's my bet. I know that there were calls that the BOJ is gonna raise rates to zero or to remove the YCC in March, but it's not likely because there are three tallies of the wage negotiation from Rengo, the biggest trade work group in Japan. The first is going to come, I think it's either today or the 15th. The second tally is going to come in after the March 17th to March 18th BOJ meeting, and the third is going to be in the early June. So I think it's safe for BOJ to observe at least two of the three tallies from the Rengo wage negotiation before they made a rate decision, and I think out of the 9 committee members, board members of the BOJ, 6 of them are outspoken. 3 of them, the rest 3 are basically silent. But among those 6 that are outspoken, there is no consent. And the 3 of them saying it should be quick for BOJ to act on rates, and the other 3 saying it might be too soon for BOJ to act. So I don't think they have reached an agreement within the board of BOJ. So it's probably, I don't know. I'm not even sure about April because I don't think BOJ is going to act before Fed acts. But it's most likely safe for BOJ to wait at least until April 28th or 29th for their policy meeting to decide where the rates go.
So in the meantime, there's liquidity there, financial conditions still loose. Do you go with the market there in Japan as well, and you don't fight it, but go with it to new all-time highs?
Of course. We started the year, actually not the only this period. We've always been long Japan, long US, and long crypto. So that's the 3 main bets going into this year. We are still in this play, and we don't see the reasons to cap our gains. But again, we were pretty cautious at the beginning of the year to see U.S. equities blowing up. So we had some covered calls, and especially on semiconductors. But then the covered calls, the benefits of covered calls is we just deliver the stocks. We don't really need to pay the price of betting on the wrong end. And besides, we were doing that for the purpose of hedging. And for Japan, there were different voices among our investment committee because some of them seen this being the Japanese stocks being too high, basically driven by sentiments. But others like me, I think the improvements in ROE has been amazing for the past year. And actually, in 2010, the ROE of the Nikkei 225 is about is in the negative territory. But last year, the ROE of Nikkei 225 is about 10%. It's amazing improvement, and I think that's our year to be proud in. But again, we have bets in Japanese yen because we think the BOJ is gonna make a move on rates and on YCC eventually this year. So in a time frame of 1 year, betting on yen, I think it's a safe bet. But yen and the Nikkei 225 is having a very direct negative correlation. So you can see from the past few days when yen is gaining strength from about 150 to 147, Nikkei 225 dived. So with that's the thing that I think people should keep in mind.
And just very quickly on cryptocurrencies.
Yeah, we have been believing in crypto, and especially in BTC for quite a while. And we are holding BTC and ETH in our portfolio, but we are not looking to add the proportion of our holdings on crypto at this point.
Okay. Enzio, can we turn your economic clock to mainland China? What's it saying there?
Yes. Well, there we have the excess, a bit like Japan, this Japanization of China, the excess supply of money, excess supply of goods. I'm afraid the nub of the issue there remains for me, perhaps quixotically, the state party capitalism that I've been ranted on about since January of this year, as you know, whereby the party already has cells in individual companies, but also takes, from the books that I'm reading, takes more active roles in companies. And I think that may thwart some of the private sector zeal to get things done. That, at least to me, is a major problem in China. And otherwise, I think there's a lot to be proud of in China, but I think that's one that may be stymieing the economy. So I see China as Japanizing a little bit. I don't trust this rally in the least. I think that it's as you were pointing out in your excellent notes, Peter, it's very much the state doing the national team doing the buying, trying to prod the market up. But I don't think that has legs. And as Andrew Sullivan taught us last week on our show, China represents, and Hong Kong thus represents, good trading opportunities. But this is not a long-term buy and hold story until this economic state party capitalism issue gets resolved, perhaps certainly more in the lines of allowing companies to go back to doing what they're good at, which is making money.
What's very noticeable about your economic clock is excess liquidity everywhere in all the major regions,
yes.
The US, Japan, good China.
Point. Europe, yeah. So that's why, yes, there will be a market crash at some point, but I mean, as an economist, we know that if you say it long enough, it'll happen. So we can't duck behind that. But there is this excess supply of money sloshing around really in the world. And that then is optimistic for markets, even if they don't have, because the money has to find a home.
James, do you trust the rally in China? Enzio doesn't. What are your thoughts?
I think it's a good sign, because the Chinese market has been that we've seen the Chinese market en route for too long, and I think any sign that the market is improving, it's a good sign for us, because we still have about 10% of our allocation in the Greater China markets, and the sentiment is bad. That's indubitable. But I think the Chinese government is trying to tilt the sentiment little by little by a effort to at least first to stop the quant shops and then stop the shortings, and then they kind of built a physical bottom for the market. So the people participating in the markets have some level of confidence at this point. I think that's a good sign, but I don't know how many massive stimulus packages are going to be released. And apparently from the meetings that we just have, the NPC meetings we just have, we didn't see much. But though we still have the Y list, we still have the $2 trillion overseas state SOE funds that might be going through Hong Kong to buy A shares, and we still have the 25 bips cut in the 5-year midterm interests, and we still have the 50-point cuts in RRR. I think all of these are pointing to a good direction, but I think range trade might be a good idea for now.
Okay, well, great to hear your thoughts there. Very interesting discussion. Thank you both very much. That was James Wong,
Thank you,
who is Chief Executive Officer at Cathaysia Securities, Enzio von Pfeil, Capital Preservation Specialist at Financial Shield.
Peter Lewis's Money Talk.
I'm joined now by Dan Kerrigan, who is the CEO of Interactive Brokers Securities over in Japan. Morning, Dan.
Morning, Peter.
Now, we've had quite a lot of economic data out over the last few days from Japan, but the picture seems to be quite good, doesn't it? That it's painting. Wages are rising, seem to be rising quite sharply. Japan's no longer in a recession, as the data was initially pointing to. We've got inflation creeping up as well. Things are looking positive, do you think?
That they are. So Mr. Abe from his legacy is still with us. I know we started Abenomics around 2012, and there's been a long lead time, but it does appear as though some of the policies that he instituted a long time ago are starting to bear some fruit. So you raised a couple of good points. So we're at the stage where we have our annual wage negotiations, in Japanese called the shunto. And with as much media coverage as there has been with the Nikkei recovering its bubble levels of about 35 years ago, there's been less attention paid to the wage hike negotiations that we're seeing currently. So for the first time, really in about 30 years, we're seeing wage hike requests in excess of 5%. Mm-hmm. So there has been one of the larger industrial labor unions called the UA Zensen actually managed, in some instances, a 6.7% hike. And the larger labor union in Japan, the largest one is called Rengo, and they're proposing a 5.85% hike. So these are relatively large, and I think they're material. We've had stagnant wage growth here for the last several decades. It's one of the reasons why we've been bumbling along here with not a whole lot of economic growth. So on balance, this has to be taken as positive, of course, with the commensurate productivity gains that we need to see as well. But on balance, we're going to see a little bit more money circulating among the consumers. So that has to be taken as positive.
And is the consumer feeling positive? Does he feel that real wages are going up and that he can go out and spend more?
Well, I guess it's one of those questions. It depends who you talk to. Overall, as we know, consumption is still only about 60% of this economy. And so for a post-industrial economy, for lack of a better term, that's still quite low. There's still too much emphasis here spent on CapEx. The upward revision in CapEx was the thing that saved us from going into technical recession in the last measure. But I still think that consumption taxes are too high here. I think they could borrow a page a little bit out of Hong Kong and Singapore and understand that flat taxes are actually good for everybody. But again, that's not my fight. And I know it's culturally, it's not something that's going to be accepted anytime soon. But I can tell you just a couple of things anecdotally. So one, in light of the wage negotiations, we are also seeing some increases in consumer prices. I can tell you at the local Starbucks here in our building, for example, a cost of a tall coffee of the day has gone from 383 yen to 414 over the last couple of weeks. So that's about an 8% bump. That's not insubstantial. Unfortunately, it's a little bit more than the wage gains that we're seeing here. But we're certainly seeing some price pressures on the consumer side. So I guess you have to take a step back and say, fine, consumer prices are going up. What does that actually mean? Well, keep in mind that over 50% of household assets here in Japan are still being held in cash. So clearly now, if you're losing 2 to 3% on your savings, you're going to be incentivized to either put that money to work in the markets, find yield, or go out and spend it. There's no point in just keeping it in your mattress anymore. So to answer your question in a long-winded way, we are going to start to see some changes in consumer behavior. And I realize there's an aging demographic that is just going to continue to hoard cash. But I think some of the younger people that are in their prime earnings years realize that with the markets recovering here, they will have some savings and some assets when they finally retire. But let's go and let's go and live a little bit and spend some money and have some fun.
But as well as the consumer looking at these wage negotiations, of course, it's very important for the Bank of Japan as well, isn't it? They're looking at this very closely. All sorts of rumors in the markets now that they're ready to finally raise interest rates from minus 0.1%. What do you think the Bank of Japan's going to do?
Well, you're right. We've had negative short-term rates since 2016. which is a bit of an anomaly. So it does look as though what the markets are indicating, both the topics and clearly the FX market, they're discounting in just a modest hike here. So with the earthquake that we had earlier this year, that took a wage hike off the table for several months, but the markets are indicating that we're going to see a relaxation of yield curve control, if not in March, then certainly in the second quarter. And I would expect, of course, any hike to be somewhat modest. They don't want to shock the system, but this would be a departure from what's been in place since 2016.
Well, when the Bank of Japan talks about normalizing interest rates, I think they have a different understanding of what normalizing interest rates means compared to, say, the Fed or the ECB or other central banks. Maybe they think going to zero is normalizing rates. What do you think is in their minds when they talk about normalizing?
You've actually nailed it. Normal is a relative term here. Again, the BOJ's, regardless of what they do in the coming quarters, is still going to be the outlier, and Japanese rates are going to remain much lower, regardless of what the Fed does. That spread is going to be in place. So you can see dollar yen's bounced off the 150, 151 level, come back to 146 or so. And again, we don't make predictions, but I've got to think that rates relative are going to remain much lower. I'm sorry, that's not a very insightful comment, but they're going to gradually have to raise rates as we see consumer inflation come through.
But we're not going to see rates at, say, 5% like they are in the US.
No, we've come a long way to get back to where we'd been in 1989, and I don't think anybody wants to endanger this nascent recovery that we've got going here, at least in the markets.
So with interest rates where they are, I mean, monetary policy is still pretty loose, isn't it? Certainly a long way below what would normally be regarded as neutral. Wages starting to go up quite sharply. Mm-hmm. There's a lot of liquidity slushing around in the system. Is that what is driving the markets higher there?
You have to think, yes, it's looking for a home. We're going to continue to see search for yield. We've had various products in the past that have attempted to fill the gap in where savers can get a decent return. We saw, as you know, a couple of decades ago, the rollout of the REIT market. Obviously, the U.S. market's been a very attractive alternative for Japanese retail investors. I think we just scratched the surface there. But I think it's an exciting time to be here. It kind of reminds me of the U.S. sort of in the late 70s, early 80s, when not a lot of people had brokerage accounts, and they started to understand with the recovery that we saw under Reagan that it was okay to own stocks. So Japan's really on the cusp of understanding that, I think, on a retail level. So it's going to be an interesting several years ahead of us here. And if we can start to see, just another thing that we're seeing here is just a little bit of a change in Japanese managers and understanding that shareholders matter. So it's probably a topic for another day. But the shareholder engagement that we've seen just in the last several years has come off a very low level, but it's encouraging to see that wanting to engage shareholders from management and hiring proper professionals in investor relations roles is something that we continue to see develop on an anecdotal basis.
What was noticeable is after reaching all-time highs last year, last week, both the Nikkei and the Topics, then when these rumours started to come out about the Bank of Japan ready now to raise interest rates, the market retreated very quickly, didn't it, over the past sort of few days? Is that a temporary blip, do you think, and we're going to get back to all-time highs?
I do. We're sitting on some short-term profits here. There's a lot of short-term trading activity here. You keep in mind, I think about 80% of the day-to-day activity in the Japanese financial markets is driven by foreigners. A lot of that's been being driven by derivatives and futures and options. So you have to keep in mind that there's a lot of nimble money out there. And sorry to quote Warren Buffett again, short term it's a voting machine, long term it's a weighing machine. I still think that there's a lot of value in this market, and we're just starting to realize it now. So I'm sticking to my guns. I still think this market is quite constructive.
And foreigners, they're participating fully in this rally. They have a history, don't they, of sort of missing out on rallies that go on in Japan. But are they participating now?
They are. Again, the good thing is that there's still a growing chorus of people who think that this is a false dawn. Maybe these people have been burned too many times. There's some very experienced people that are saying, again, you're not going to fool me again, which is probably healthy for the market. It's nice to have a nice discourse. And anytime you get people on the same side of the boat, you normally set up for a reversal, but not everybody's on the same side of the boat yet.
But what is noticeable, isn't it, that compared to when Japan was last at an all-time high back in December 1989, the market right now is much cheaper than it was then.
That it is. And again, there's a tremendous amount of skepticism still, as I just said, but you don't have academics publishing books saying Japan's going to take over the world or Japan is number one or the rise and fall of great powers. And in hindsight, it's easy for me to sit here and say that, but there's a reason the people that penned these books were academics and not hedge fund managers. I mean, that was the top tick in the market.
I think we all remember, don't we, back in those days in 1989, a very different economic situation where you had something like 15 out of the 20 world's biggest companies, Japanese. Everyone remembers, the story of the land the Imperial Palace stood on becoming worth more than the whole of the state of California and so on. Very different environment compared to now.
We've been here before, and again, we have the luxury of hindsight. I dug up a report from 2013 where 4 of the largest banks in the world were all Chinese. So again, nobody rings a bell, but the fact that there's a degree of skepticism, I think, is positive, and we need just to have our assertions and then dig up and get the evidence to support our views. And right now, this is not just a one-way market. There are certain companies that are actually taking active steps to get their financial accounts in order, do a much better job of capital efficiency, and importantly, communicating that plan to the market, to institutional investors. And if you have all of those things and you can execute, then clearly you're sitting on an exciting investment story. But this is going to be very uneven. And so, again, talking my own book, you can buy an index or you can continue to look for those companies that are getting religion in terms of how they run their businesses.
Dan, always a pleasure talking to you. Thank you very much indeed.
All right, Peter. We'll see you again soon.
That's
Thanks.
Dan Kerrigan, who is the CEO of Interactive Brokers Securities over in Japan.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning. Just a reminder once again to take a look at my website, peterlewismoneytalk.substack.com, where you'll find my daily newsletter with a lot more business and finance news from across Asia to go with this show. I'll be back tomorrow when my guests will be Andrew Ferris, the CEO of Econosis Advisory, and William Marr, Chief Investment Officer at Grow Investment Group. In the second part of the show, we're going to have a discussion about the decarbonisation of shipping with Lawrence Yu, who's Executive Director at Civic Exchange. Please join me tomorrow.
Money Talk